recessionary concerns, but also inflationary concerns in the picture for 2023, right? I mean, those Dutch tech export restrictions, for example, that to me sounds more inflationary if you have supply chain bifurcations continuing. You have a big reopening in China, more demand coming from this second biggest economy in the world. How key will prices be on where markets go from here?
No, it'll be key. I think what we're moving from is peak hawkishness, peak inflation this year. What's the pace of the inflation decline that we're going to see next year? And I think the key there is what are the economic costs to this peaking inflation? Obviously, we have higher interest rates around the world. Now, if you separate that inflation picture, headline inflation is improving because petrol prices are down. We're seeing lumber prices down 70%. Container ship pricing is back really below pre-pandemic levels. So we've seen a correction in headline, but the core wages and rents, which is 2/3, will take longer. So we think it'll be 2024 before you get below 3%. But the market reacts to rate of change, and the rate of change will start to improve, we think, going forward.
Where do you invest until you get there?
Yeah, I think we've started our first port of call beginning of October. We upgraded U.S. investment-grade bonds and U.S. Treasuries. And we saw in middle October a peak in U.S. Treasuries, at least in the short term. And obviously the CPI figure last month was a big boost, and we've seen since then a very large Treasury rally. Nearer term, we need to digest those gains, but when you can get 4 to 6% yields in investment-grade paper, that's attractive. You can wait, you can handle that volatility and still earn good income. High-yield paper, still default rates could pick up with an impending recession, so we're a little bit more cautious. But income is your first port of call, and it's a gift because we've been in zero rates for so long. For the first time, investors have that option.
I need to get your views when it comes to mainland assets, because you have been accumulating Chinese equities since the end of the Party Congress. All of these very fast-paced developments when it comes to an exit out of COVID-0, is it making you even more bullish? Take a look at this chart when it comes to the snapback that we've seen for just the Shanghai Comp as one example of the big move we've seen back into positive sentiment. That peak of the rally summer, the summer rally, I should say, the rally that we saw in summer could be the next target that we see.
Yes, and I think after the Party Congress, there was deep pessimism because the market really was pricing no change or no pivot to the China COVID restrictions through the end of next year. As well, we had seen no bottoming in the property market. Since then, we've seen two things, of course, the loosening and more targeted COVID restrictions, and we still have to get through winter in China. And we know the virus is more transmissible and vaccination rates need to pick up. However, the market is now starting to look through to next year, perhaps second, third quarter, when we get more gradual loosening of policy. So it's encouraging these steps, and they were a surprise to the market. But the risk reward was attractive because it wasn't pricing in anything just a few months ago. The property market also is not yet bottomed. However, we've seen more measures also since the Party Congress. We've seen reserve rate cuts, and we've seen more financing for local property developers. Hence, we also think that could also bottom in the coming months. Of course, we know that property is for living, not for speculation, so we're not expecting a huge rebound, but all the market needs to see is a stabilization. And those factors are starting to align as we get into next year, and the risk-reward is attractive to start to accumulate.
If we see the focus being shifted back into pro-growth, that 5% GDP target being thrown about, and we do see that shift as we get into potentially a full reopening by, say, the middle of next year for China, how do you accumulate positioning ahead of that if you're assuming that reopening?
Yeah, I think the reopening will be gradual and incremental, so there won't be a big bang, but gradual as possible. And I think consumption is key. We know consumption has been depressed for a number of reasons. So those kind of names, especially local brands, will benefit. Also, you're going to have you want to be aligned with the government in terms of policy. So obviously the whole EV space and other related spaces also benefit. But consumption would be the first port of call because that's been the most depressed.